Hello and welcome. We will be starting very soon. So we'll give everyone a minute to get in here. Welcome as you're coming in. As I mentioned, give everybody a minute to get in here before we get started. We'll try to start right on time. So a lot to talk about. I always like to save room for questions and also be respectful of everyone's time and try to hit our mark each time as well. So we'll give it another minute or so, and then we will get going. So I hope you are having a happy Wednesday, good week. Don't know where you're joining us from in the country, in the world. It's pretty chilly here in the Midwest, but maybe we're closer to spring than not. So obviously today we're going to talk about inflation. I'm going to do this one a little bit different in terms of trying to inject my own into there, as well as hitting a lot of economic slides and talk about them. And so it's not a totally for beginners, but it's not overly complex if you were talking to economists or whatso. And hopefully I can put my own spin on it because I do go to a lot of conferences and do hear from economists, market analysts, actually big investment managers, etc. So let's go ahead and get started. So let me share my screen here. Get stuff scooted around. Okay. So hopefully you can see my intro slide. And as I mentioned before, I've been really working with AI and I like to generate the images. So sometimes they're actually funny if you pay attention and can pick out things. It's like kind of a Where's Waldo thing. So obviously for a lot of people, fun subject, talking about inflation, economic data. Woohoo, here we go. So let's dig in. I always like to do my customary bottom line up front, which we can kind of tell you a little bit about what the entire thing is going to be about. And then during the presentation, we'll get into the details and then at the end come to some conclusions and questions. And especially on something like this, I don't think that the entire thing is going to rivet you the whole time. There'll be parts that you find fascinating or that you like. And when those times come, or if it's something that's not that you have a question about, write it down, put it in the questions thing, put it in the chat, and our staff will move it over to the questions as we go. Don't try to remember to the end because then you forget. And if we don't have questions in there, it's not near as good of a thing. So bottom line up front, I want to try to simplify complex for you because a lot of investment, inflation, economic data, can be really complex, especially if that's not your forte or background. So I'm going to try to make it a little bit more accessible, put it more in graphical format, give you some examples. Inflation pressures, policy pressures, like that's coming from, obviously we're going to look at it from our perspective, the U.S. American perspective. Policy pressures like tariffs, fiscal stimulants, and some other ones could spike inflation. Geopolitical instability and recession, or a whole, world recession instead of just a U.S. recession, absolutely could prompt the opposite. Stabilization, whichever way we go, more than likely, the consensus I hear around makes a lot of sense to me that the new normal is probably, 3 to 4% inflation, not 1 to 2, where the Fed was trying to target 2. And a lot of people think we're just gonna, once it's said and done, go back to that old normal of super low inflation. So we'll start out with a poll question here. So just for fun, see what you are thinking. Poll question 1 on the inflation outlook. Where do you think inflation is going? So go ahead, answer now, get it in. Let us see where everybody stands. Do you think it's going up? We're at a little bit higher than the last decade or so already. So if you think it's going up, you're in that camp. If you think it's going down and we beat it, you're in that camp. If you're just like, we're going to stay about where we are. If you have no idea, I gave you an out if you want to choose that one. So let's go ahead and we'll shut it down. So if you haven't got it in there, push it, close it. Man, you guys are single-minded. Everybody thinks it's increasing. So I guess it makes sense a little bit. You're going to join a webinar to hear about inflation because you're worried about it, right? If it was going down, unless you really thought we were going to hit deflation, you're probably not as worried about it. So that kind of makes sense with who we've got here today, that the answer would drift more to that side. So let's go on. So I'm going to transition now, from my cool slides. You can see my AI there with nonsensical words. And we're going to deep dive into some of it. Again, try to keep it a little graphical here. So a lot of the charts that I use inside of here are from a company that I like called Clearnomics. And they help pull together a lot of this data, make nice charts, make them really up to date. So this is as of, the end of January. So we're only talking about a couple weeks old, really. And there'll be varying lengths of history depending on what we're trying to zoom in on. So the CPI, we've all probably heard of that in passing in our articles, that consumer price index, and it's looking at year over year change when you're seeing from zero, sometimes, 2008 could have some deflation, but real temporary. And a lot of times you'll see a spike afterwards. But how high, does it go? And of course, you probably heard, depending on your age, at least your parents or someone talk about interest rates in the 70s and 80s and having a mortgage back then, when you might get a mortgage at, 13%. And of course, the truth in lending statement at that point looks atrocious when you're going to pay 3 or 4 times more in interest than you pay in principal for your house. And then we had a long period of interest rates going down until, most people the last 25 years just remember the low interest rate environment. And CPI really is a driver of that. It's, what do things cost that people are buying? And so, it'll use a basket of goods, and you'll see it has this core one as well, which tries to take out like food and energy, because those things tend to spike a lot. And if you take out the food and energy, you can kind of see how that yellow line, stays a lot more in the middle. And a lot of these spikes were food and energy. Now, that's interesting to look at, and it's a very good perspective. But if you're a regular person, like most of us, you have to buy food and energy, gasoline, or powering your house and staying warm and cooling yourself in the summer. So energy is very real in that. But you can kind of see how, we really have, just kind of stayed here in the middle without shocks until recently with, the whole COVID breakdown of things and then spiking afterwards. So, but it does look like it's stabilizing now, right? So we did get it to come back down, right? And now it's starting to go sideways. But that's not a lot of data to say that it's just going to keep going sideways, right? And that's what people are worried about. And so if we want to be curious and look at, what makes up these CPI numbers, and you can see we could break down into transportation, shelter, housing, medical, healthcare stuff, food, medical care commodities, the things they actually use in it. So the actual stuff versus the services. And then cars. So we got used cars, we got new cars, or vehicles, whatever. We got energy, and we got apparel. And so just like in the past, we said it takes out a lot of the volatility with food and energy. Food and energy are not really causing any of the problems right now. Look at new cars too. They've actually gone down. But big surprise. I can remember not that long ago, less than 10 years ago, when a good car was, 30 some $1,000s, and now the car's like 50 or 60. It's crazy how much a lot of the high end has gone up in price. And I'm sure if you bought one in the last few years, you probably agree that is a big price increase. So to see it like kind of stagnate or go down a little bit, probably not a bad thing. But it is going to be hard for the car companies to just decrease the prices. So maybe they'll just go sideways for a while. But, really where you're seeing it in these transportation services, which is weird because it's like, hey, if you buy your own car, that's not really inflating or get more expensive. But if you don't have a car and you need to fly, train, bus, those costs gone up a lot. And shelter. And generally, we're all paying for shelter, whether we're renting or, paying on your mortgage and associated costs that come with that. And so, these things hit people, probably urban, especially more on the transportation services. But still, interesting to see it broken down like that, to see how it comes out there. Here you can see, all right, well, what if we break it down, between goods and services? And really, if Americans are feeling the pain, probably from services. We're a service economy. So if service prices are going up and staying high, and you can kind of see, that's been the trend. you're going to feel it more in our country. We had this big spike on goods, and that really was that supply bottleneck. The stuff wasn't getting here, from Canada or Asia or whatever the case. And so you had that spike. And when that went away, that was the big debate. Is it real inflation or is this just supply chain stuff from COVID? And that is kind of the evidence of the supply chain thing, and then it correcting, and even reversing, and then staying down to where it's not causing any of the CPI increase at all. So really the core services, and then a lot of services for us, and it could be a good thing, has been wages have been going up, and we've talked about it for a long time, for 25 to 50 years minus inflation. A lot of the middle class and blue collar workers and what so haven't gotten much of a raise over that, and so now some of that has adjusted, and you're seeing that over here. And then this will look at PCE. PCE is just another way to look at a basket of goods. It's the one that the Fed actually likes. It's their official one, even though CPI is the one everybody always talks about. But it helps to capture a little bit more beyond just the direct consumer to people or organizations that may buy for them. It helps to capture a little bit of when people substitute like something that's expensive for something else, but it still works. And so that's why they tend to like this one as well too. And so you can see on PCE, very kind of similar type thing, but lower, right? So the inflation's actually a little bit lower when we look at this measure. And then we can compare, right? And so we can look at the CPI versus the PCE. The PPI is producer's price index. So it's like, what are they paying for stuff? And so a lot of times this can be leading before this. And so it's an interesting thing to look at. If the costs are going up for the people that are making the stuff for you, eventually they end up passing it down, usually, right? And there could be room for less inflation in the future if something would make companies less profitable, because right now companies are super profitable and they have a lot of power. So anything that increases to them, they just pass it on to you. But if companies were to take some kind of shock or something happened to where they would give some of their profit margins back up to the customers, you could actually see a price adjustment down. Not to say that probably happened in our uber capitalist society, but it could, right? Then this, I'm probably going to put this slide before the other slide, looking at that, industrial production number and then utilization. And so utilization just means of what we could produce, what is our capacity to produce things in the US, how much of that are we using? And so we're using about 77%, which is, not really even at the highs of, when we're up at 85. And if we come below this, then there's something going on to where there's not enough demand. So it's probably healthy to be a little bit above this line. So we're in a healthy area there. And if this pushes up too high, then you're going to come in, again, some of those things where you're going to have shortages of things or bottlenecks and inefficiency that's going to pass on to inflation too. So this is not a real problem either in here. Now, this is interesting. So we're kind of switching from looking at economic indicators of inflation like the CPI and PCE and all that stuff, just looking at interest rates, right? And interest rates are, just what we set and what the market is kind of setting to say, how much are we going to lend money, whether it's going to be short term. And a lot of regular people, we think it's easier to think about almost like CDs, right? Versus like all the different bonds. So if I'm going to buy a 2-year CD versus like a 10-year. So if you're going to lock your money up for 10 years, you probably want more interest, right? If you're going to get it back in a year or two, you'll take lower because you can get your money back faster, right? So this makes sense. This is a normal yield curve where the shorter stuff is less interest than the longer stuff. And that's pretty normal. And there should be a healthy spread in between there, depending on what's going on. But you can kind of see everything got real tight here around when COVID was coming over here, and really took a dip down where all the rates went down. And then when things started getting better and inflation started rearing its head, you started getting this backwards thing where you actually got paid more interest to be short than long. Okay. And traditionally, historically, this has been, until this happened right here, this has been almost 100% predictor of recession. And then it didn't really happen this time. Now, I've heard a lot of economists say, oh, we had a rolling recession where different industries had little recessions at different times rather than everything all at once going down. And that technically we kind of did have, a type of recession, even though GDP stayed positive, which didn't make it an official recession. And now you've seen that these swapped back, which is like a good indicator to people that things are getting healthier again, that there's a spread, but it's not much. And this was very anomalous. So very weird, if we want to put it in regular terms. And so now we can look back farther. So instead of just looking like here to here, we can look back farther. And again, looking back at that, 70s when it all started here up to the 80s, interest rates hit real high. And so you can see here, we had this really low period, for the last 10 or 15 years that we've had. And then now we've come back up. I was at a conference recently where I think it was Schwab's economist was talking about from here to here and from here and here. So like that's normal. This is anomalous. This low is anomalous. And so he's like, it feels to me like we're getting back to normal. And we had like a 15-year period, 10 or 15-year period, like anomalous good low period, right? And so that was interesting. I hadn't heard someone put it like that, but probably a little bit healthier interest rate rather than you don't really get paid and you're losing to inflation on your savings and your short conservative type investments. So that's an interesting perspective too, but it puts things in context because a lot of people right now, interest rates have gone up here. And they're just saying, well, I'm going to wait to buy a house or to refinance or, to upgrade or downgrade or upsize or downsize until interest rates go back down. They may not go back down. Okay. And if we do have a period with a lot of the stuff that we're doing policy wise and what's out, they could go up for a while before they come back down and hit in kind of this range. And that's kind of my thing is I actually kind of agree. I don't think we're going back down here unless there's a big recession or something for the long term. So, take that as it is. It's just a different way of seeing it. So the red line is a year ago. Okay. And you can kind of see this is like, again, if we want to like make it easier for regular people, this is like the short CDs, 6 month to 2 year to, 20 to 30 year out here. Okay. And so you can see a year ago, the short stuff paid all the way up here at 5.5 and the long played, that's 1% higher to not lock your money up. It's kind of wild, right? And a lot of this is because people didn't believe that interest rates were going to stay up here, right? They're like, oh, they're just popping it up. They'll get it under control, come right back down. So there's no way I'm paying you that high, to lock that in. So from the other side of the people that are borrowing the money, right? And now, where we can see right now, it's the short is lower than the high, and it should slope up like that. So that's normal yield curve is what they call it. Okay. And this just kind of shows you what the Fed's done, right? So what's the Fed doing in terms of raising rates or lowering them? And how did that look like when we went through? Here's, when we're looking at when they raised rates before the financial collapse, and then how fast they dropped them. And then it stayed down there for a long time until people got more confident it was getting better, heating up. Boom, raised it up. COVID dropped it back down. Now raising it back up and started to drop it. And interesting, I saw a lot of charts like this for the last 6 months where people were kind of predicting here. And of course, they're predicting here, and that's the markets kind of build it in. They kind of tell that by what the bond market's doing and what the stock market is pricing in. But now I'm seeing a lot of things where this is changing now. The prediction is not to go down like this. The prediction is to go sideways, and maybe by the end of 2025, some rate hikes again. Okay, so you're split. Even the super duper smart guys that do economics and predictions now are in two big camps between we beat inflation, it's going to go down, or we didn't beat it, and now with the new policy stuff it could go up, so we could see some raises. But there is uncertainty here, and there's people predicting each. I'm not going to spent a lot of time on this. I put it in here just in case it was interesting based on how the conversation went, but it's kind of complex to understand. It's just talking about when the Fed was like raising interest rates, what did it look like for how long, right? The biggest one here was 1977, which if I go backwards, then what was that? Long interest, oh wait, the long interest rate chart. 1977, that's when they started raising around here all the way here. So it was a long time for them to get this under control, okay? And then you can see where we are. Where's the current rate here? Okay. And so we could either see that this is the end of it. This is the end of this when it's done. Okay. And we're on to cuts now, or it could keep going up, right? And so then you can see cuts throughout history as well too. And 89 was the longest one there. And again, that's kind of after they beat that 70s to 80s inflation. And we had that long period where they cut rates here. And then again, from 2000, et cetera. So anyways, it is interesting to see that. And I apologize that it is a little bit technical, but hopefully I'm helping you like digest it a little bit and just really think about the things that are out there instead of just making judgment calls from what the political pundits say on their respective news channels. So this is the real deal information that we should be making decisions off of and judging. So let's do the poll question number 2, launch it. So just asking you, do you think that national, economic and internal things are more important to driving inflation? Or do you think the geopolitical stability or instability, depending on how you want to frame it, will drive interest rates and inflation more? So go ahead. Hopefully you're voting. Let's get them in. And again, throw your questions out there whenever you think of them so that we'll have some good ones at the end and I can help answer some questions for you. So let's go ahead and close it off. So it looks like you're split pretty even. This is 50-50 between, is it going to be national or is it going to be geopolitical? And fair enough. I think if nothing bad happens, like Russia, Ukraine, Middle East, China, Taiwan, the wild cards in there with Iran and North Korea, then we're probably right. It's going to be the national economic issues. But these things could happen. Something bad could happen that pushes things out of whack. I like to throw this in there just because it's another interesting thing that does have influence on things. When we're running hot as an economy and our GDP is high, again, it can push inflation up, right? And so when we're looking at this, it's just saying, these are the different time periods. Okay, so just going back, a year and a half or so and looking at each quarter for the last year and a half, how is our GDP doing? So gross domestic product, how much do we make? And you can see where it comes from. So people spending, so you always hear that consumer spending, how much domestic investment there is, people investing in things domestically, and then how much the government is chipping in and contributing, which we'll probably see that go down pretty significantly, and then exports. So are we making money off of selling stuff to other countries, or are we paying them more for their stuff? So you can see, traditionally, this takes away from our GDP because we buy a lot of other countries' stuff, which is not necessarily a bad thing, because especially the last 20, 25 years, that probably helped retirees a lot. Like with that low inflation was a lot of the cheap stuff we could get from all around the world that made our dollars go a lot farther. And so GDP for the US has actually been doing quite well. I mean, this is super for us, way back 2023 at the mid into the year. And you could see now it is changing though. If you see like, more recently, it is consumer spending that's driving a lot of the GDP, but not much investment. So it looks, who knows if this is a trend yet, but it looks like private companies, individuals, institutional type investment is not feeling the greatest about the future to be pumping a bunch of money into investing in new things, but the consumer is still going strong. It's got money, albeit from savings or credit cards or what's so. They're still spending. And then the government's been kind of, I would say, pretty average. But I mean, we can expect this to go down. You've seen everything that's happening. And so I would imagine the government spending is going to go down and not really support GDP that much. And then, of course, exports, we'll see what happens with this. I mean, I don't think that we'll make money from our net exports, but maybe we can close the gap, and we'll explore that a little bit more. And so you can see the trade imbalance. So going all the way back, about, 30 some years on this, you can see we got close, was that probably around Clinton time frame, to having parity here. But since then, we have a negative trade balance, and it's averaged around 40 billion. Obama time period got a little bit better, went sideways. And then Trump time period, probably a little bit down, but still sideways. And then Biden went way down as well here. So again, not blaming or anybody. This is just what we're looking at. And now we're going to see what happens on if we bounce back with tariffs and stuff. So the bad thing about the tariffs is, if we just put them on other people and then they just put them right back on us, it's not necessarily going to change a ton here, because we're going to buy less too, right? We might consume more of our own stuff because relatively it becomes more affordable. But if that pinches the consumer to just cost more money, you could see the spending go down, and that could be bad for us recession wise. Okay. That's why a lot of people, economists, are going to say tariffs just don't work, because they're just taking money out of the system if both sides do it evenly. Okay. And this just says, who is our trade imbalance to? You see China is our biggest, but it surprises a lot of people that it's, only about, 1/4. It's not bigger than that. And then Mexico's our second, and Europe's actually our second. Mexico's our third. And you can see how Mexico's expanded. It's interesting. Again, I was at another conference where they were talking about this and broke it up. And the biggest, import from Mexico is actually Ford and GM with autos. So it's like our own companies that move some of their plants over there to ship back into us. So it's not even like Mexico doing it to us. It's like our own companies just trying to shave some costs. And then another thing to look at, because this also contributes to inflation, is what is the underlying stuff costing? And these are some important things. And, if we try to put too many things on here, it'd just be hard to read. And this is just kind of looking at just the last 5 or so years. And we can see oil, we can see corn, and we can see copper. And so, of course, again, kind of COVID, everything kind of dipped down, especially oil there for a while. And then everything kind of rebounding back. And then so energy, kind of bounced up, then came back and went sideways. That's $71 a barrel. That's pretty sustainable. Now the one that's kind of jumped up and will probably stay up is this copper. I mean, there's going to be a lot of demand for it between all the batteries, the electrical stuff that we're doing, upgrading the grid, solar panels, electronics, you name it. I imagine you're going to see more pressure on copper. And then corn, I think it's just going to fluctuate depending on foodstuffs. We use corn for a lot of stuff. I mean, even, biofuel and stuff like that. But again, I would imagine you probably see it pretty consistent with just spikes up and down, copper trending higher, depending on what alternative energies do. Oil probably goes sideways. There's a lot of pressure on that because different people can pump more, like we're talking about in the US, or you have like the big Middle Eastern, whole group of countries and that'll manipulate the price to kind of keep it exactly where they want it, where they can make money, but they're not raising it so high that they're pricing themselves out to where alternatives and get developed too fast. So this is a lot more manipulated than a lot of other commodities. Unemployment. So you see this, it says U3. U3 is like the main unemployment. It's like people that are out of work divided by how many people could work. There are other ones like U4, 5, 6, which will put other components into there in terms of like underemployed or or working part-time would want to be full-time. But the U3 is generally the main accepted for like real unemployment, people that don't have a job inside of there that want a job. And so you'll see, kind of the up and down of it. Generally, when it starts going up, it'll start driving, or when wage growth starts going up, it will contribute to inflation inside of there. And the more that, so this is the unemployment on this side, the more you go up on this, the less unemployment there is. And so if there's less people to choose from, a lot of times you have to pay more to get them, right? And so when wages go up, then that will contribute to inflation. It can be, upwards of 30 to 60% of inflation coming from what we have to pay people to work, right? And huge disruption, obviously, right here, kind of before and after COVID, and then continuing up and staying at. This is pretty significant wage growth for an extended period of time. And that's where you're seeing some of the, I think, the stickier inflation come from, is people making more, right? And then it gets passed on to all of us buying stuff or going to restaurants or hotels or whatever the case, or when you buy something manufactured, how much it costs to hire all the people to manufacture it. And then this will give you that comparison of the unemployment in yellow to the inflation. And so you can kind of see when the inflation is getting, or when employment is getting tighter. So when there's less people to work and it's probably more wages, it generally will correlate with the inflation going up. Not all the time, but a lot of time it is a big cause or part of the cause of inflation. And so if we see unemployment stay up here low, because this is kind of backwards, it says inverted, the higher the yellow goes, the more you'll see a good portion of inflation be higher as well. And so then we were talking earlier about, the consumer strong and what's so. Well, and again, this is it's hard to read because they chopped the graph, so it looks like it's moving more than it is. But you can kind of see what caused a lot of the problems 2008, 2009 with people borrowing too much, on their credit cards or as a percentage of what they make, how big their mortgage is. It was way higher, back here than where it is now. So the consumer's not crunched right now, per se, in terms of like what they can pay. But on the flip side of things, interest rates are higher. So for what they have, the payments can be higher, especially if they're on a variable rate thing, or if people just start refinancing, or like I said, upsizing or downsizing, then it's going to hit their pocketbook harder as a percent of what they make. And then here you can see how do people feel about the future? Are they more positive about it or negative about it? And you can see historically for the last like 40 years, we're pretty low. I mean, this is when all the high interest rate stuff was, and stagflation. People didn't feel positive about, the future. This is when people didn't feel good right before you had the run up to the tech boom right here. And then of course, 2008 and 9, people down here. So you can see, COVID to now, people are pretty pessimistic. We haven't gotten happy and positive about the future really for a while. Okay. And then you can just see how well different countries are doing versus each other currency wise. And so when we look at us, that's that dark blue one. And this is only looking at the last couple years really, but still, from beginning to end, it's up. And the dollar's already had a terrific run before this, and it's still up. I mean, it's been kind of up and down for the last 2 years, but recently, since the elections to now, it's really come back on strong again to give it that up for that entire time period. Okay. And it's even, it was for a little while starting to push the pound. So that's what it is, Great Britain pound versus the dollar versus the euro. And you remember, when we go back here, the euro used to beat us pretty good now, but we're beating them pretty solid. And so that's a big role reversal. And then you can see, kind of China and Japan down here, not quite as strong either. So poll question number 3, we're really close to getting to the end of all the technical stuff, and we'll wrap it up. We can ask some questions. So poll question 3, that we didn't talk about all this inflation stuff. Do you think we could see deflation again? Deflation where prices actually go down. So let's go ahead and answer there. get them in. Let's see what you think. Keep it. All right, last chance. Put it in. Let's close it. I'm surprised. Everybody answered yes. So it is a possibility. Normally in the past, if you got deflation, it was a bad thing because as soon as people saw prices going down, they would wait to buy anything because they thought that it would be cheaper next week or down the road. And so without that consumer spending and everybody just waiting, it can be this spiral thing that you just fall into that's horrible. So in the past, deflation's been a really bad thing, and the Fed and the government really wants to avoid that. I think more what we could see in deflation in the future is more technologically, productivity wise, driving down costs, artificial intelligence, automation, replacing expensive wage or labor. And so I think you absolutely could see it. Now, would that be a lot of those improvements be more of a boon than the detractor from things getting cheaper and possibly having that spiral effect of people waiting to buy things because they think it'll be, we don't know. We really have not had that happen much, besides in some of the computer stuff, right? Where we see the price of new stuff come down. Remember, like 20 years ago, getting that big screen TV, you're rich. Now you can go to Walmart and get one for $400, a bigger, better 4K, etc. So we're used to that, right? We're used to that technology coming down over time. So where are people having their debt and how big is it now? So you can see if we were comparing to that 2008, 2009, how much debt that we have in each category. So a lot more, like, so 2.5 times more. Now, fortunately, people are making more money. So that kind of percentage debt to what they owe works, but it's a lot of debt. It is a lot of debt. Student loans have obviously ballooned a lot. Auto loans bigger than they were. Credit cards probably about the same. And then all the other debt. So when we look at this, taking housing out of it, people have picked up a lot more student and auto loans. So this could be a problem. And you see a lot of, when times are bad and there's recession, you see a lot of default on this and this. And those are, especially the auto loans bigger. This is going to be a problem that's got to be dealt with somehow, way, shape, or form. I think you're going to see that in healthcare and in education eventually. And so we could see some of those pressures just from the interest load that we got to pay. When we have more debt, we end up having to, print money, or we're expanding the money supply. That can be inflationary. And of course, you can see how, over the last 40 years, we've really accelerated as a country in spending more than what we make, even though what we make has gone up, and how much of a deficit we've been running. And it wasn't just to stimulate the bad time, we're keeping at it afterwards as well too. And with a lot of the tax cuts and stuff that we're proposing, to extend the Trump tax cuts, to expand more into lowering the corporate tax rate and more credits, deductions, etc. I think just to expand what was there is 3.5 trillion, and if we add some of those extra things on there, it could be 1 to 2 trillion more. And so it's a lot inside of here, and this absolutely can be inflationary and may very well be as well. And so you can kind of see where we're predicted, from where we are as a percentage of our GDP, what's just going to pay the interest on that. And so it's going to more than double over the next, 15 years or so, or 10 years is where it's got to go here. Just 10 years, it's going to double how much of our GDP is going to go to actually pay just the interest on things. And that's without it really interest rates going up that much. Okay. I heard a theory that it's actually very interesting that interest rates will stay low because the United States can't afford to pay its debt at higher interest rate. And so much of the world has a super vested interest in that the interest rates will have to stay low to not cause default and cause a major global collapse. So it's an interesting theory. Obviously, may not hold true. It's not something I would be willing to bet on our whole future on that would be the case. And then where's our money coming from when the government's collecting it? So you can see individuals kind of stayed steady but gotten bigger. Corporate used to be a decent chunk, 20 to 25%, and now has come down less than 10. And we're talking about cutting corporate taxes again, almost in half. So corporate, not much at all. And of course, we used to promise great benefits, for Social Security and Medicare, but not really charge a lot for them. And now we're charging a good bit more. So, it does take a decent amount between our Social Security, Medicare, and in our individual taxes are paying the huge majority of where things are coming from. So, conclusions. Okay, got to the end. The more fun part, if you stuck with us through this long, good job. I hope it wasn't too boring, and I sparked a few questions that help you understand or feel better about things, or at least have an idea where they're going from, that it's not necessarily a rosy picture, but we're usually more afraid of what we don't understand more than if something is kind of scary, but we understand it because you can make a plan or something, right? And so here's our conclusions. Inflation has seemed to settle, and it's looking promising from like when we look at the measures of inflation, the things that cause it, the spreads, that it's at kind of an average long-term normal level. So that's good. But there are a lot of policy pressures, and we don't know exactly kind of when you put fuel on the fire, is it just going to be a little poof, or is it really going to make it boom and catch the neighbor's house on fire, right? And depending on how much gas you pour on there, or if it's gas versus diesel versus oil, right? So when we look at the administration's policies, it could spark inflation. So you got tariffs, so if we're putting these big tariffs on other countries, they put them right back on us. It's not perfect, but the best relational thing that I've seen is for about every 10% of tariff, you're going to get an extra percent of inflation on top of all the other inflationary things. So if we were, just like we were putting, across the board, 25%, then that would add 2.5 on. And if we were going to be at 3 to 4, so now you're almost at 6. Okay, so 6%, and that's without anything else. If we have fiscal stimulus, so if there's more tax cuts, more credits, and deductions that didn't used to be there, and even though we're paying for that with debt, and these people have extra money, then people are going to spend more. More people chasing after the same amount of goods generally will raise the price of things, right? And that could stimulate the economy further, add to inflation. Labor shortages. This is one I don't think people talk about a lot, but I actually think could actually be a bigger impact than people think. If we're really going to deport out a lot of our bottom of our workforce, of like the lowest costs, where we're agriculturally and construction and service industry with like hotels and everything like that, get rid of a lot of these workers that do a great job, work very hard for the lowest wages that we have, and there's not very many people to replace them, and we have to hire people, pay them 2 or 3 times as much to do those same jobs. You're going to see a lot of things cost more. Your fruits and vegetables will cost more, your meats cost more, your hotel stays cost more. A lot of these things that people don't think about, I think, are going to come back around hard if that really gets implemented hardcore, okay, and could be very big inflationary, because wages, as we said, could be like 30 to 60% of inflation. And if we took out a big component of our economy that really helped keep wages down, this would be bad. And it wouldn't even necessarily make people happy, because I don't think most Americans want to do a lot of those jobs. Political pressure to control the Fed. So if the Fed does not get the freedom to do what they need to do to get ahead to tighten interest rates, that's kind of what happened in the 70s. They should have raised rates faster and got ahead of it and smashed it down. But instead, they just really didn't do it well, until eventually, you had a change of administrations to say, and they really hammered it hard and raised the interest rates and crushed it, caused a recession. But again, got it under control, and then over time we got down to where we were. So if we get to where people aren't free, where the administration's like, nope, Fed, don't do this. We like low interest rate, and they're going to do all these things to spark inflation, but we don't raise the rates to try to control inflation. It could let it burn out of control instead of letting the fire department go and put out the fire. Right. So these things could come together in almost like a perfect storm. And of course, we're going to pay for a lot of this with the debt. And then you put all these things together, you could have an out of control fire. So inflation could rise. I mean, rivaling the 70s or 80s if it came together in a perfect storm. Now, again, I think that's a lower probability, but it's possible. All these things are there if they come together right. Now, the other side of things, geopolitical risk, economic instability. So, I mean, we could have a global recession, right? If say China's not getting their stuff together, the wars make everybody scared. Europe gets hammered, energy wise, continuing from like Russia and Ukraine, go into recession. And we've had a good long run. We could get pulled right into it with them. And even with all those things we talked about over here that are pushing up, this pulls down enough, pulls into recession, and we don't have that inflation. And we might actually have to cut rates and what's so to kind of stimulate to get things to pick back up. Interest rate volatility. So, you could have different things happen, geopolitical with different countries, energy, in the currencies changing or dropping, and all that volatility makes people not want to invest as much. You could actually have a pullback from that. And we already talked about this kind of with this energy market disruption. Energy is incredibly important. I mean, even think about it. If you're in these cold areas right now, how much more the last couple of years we've had to pay just to heat our houses and put gas in your cars. You have a lot more disruption of that, and we pay like twice as much as we are now. That, I mean, just sucking all that extra money out that would have gone to something else. That's a huge hit. And with all these things, if people don't feel good, they don't want to spend as much. They want to build up their savings. You're going to knock that consumer spending down. And so, what's going to happen? I really hate to say it, but it's uncertainty. You could have hyperinflation for the US. We're not talking about like emerging market hyperinflation. For us, we're talking like 8 to 15%, right? Or you could have deflation if like we had global recession, but artificial intelligence and technology is doing awesome and it cuts costs, plus people don't spend. You could have things go backwards. I think it's somewhere in the middle here, but there's a good case to be made. You could have either of these. And so unfortunately, both those scenarios create uncertainty. And so that in itself will probably limit business and investments, because in uncertainty, businesses or wealthy individuals, they don't like to invest as much. You don't want to make a bet when it just seems like, it could totally go against you. It's not like an informed, good investment. It does seem more like a bet, like a gamble. And of course, smart people didn't get wealthy by gambling their money. They invested in things that when they put enough of them out there is going to grow and do well. And so the more uncertain it is to where they can't have a good thing like that, the less they're going to do it. The less people invest and put out there, and even the consumers feel like they might need to pad their spending, you're going to have a harder time. So again, check us out as a company, as well as a thought leader, and going over some of these subjects. And we have a great website that tells you lots of different things in terms of how we do it, that we do it for less. We do all these extra things that a lot of other firms don't do. So most of them will do this one category with the investment, retirement, estate planning, et cetera, but they won't do the extra stuff, like how to make sure that the bank doesn't get you, in terms of paying you the right amount of interest, or that they're not over charging you when you borrow from them, and when it's appropriate to borrow, and then doing your taxes and making sure that you're giving the least of the government that you can. And then when and if you want to start a business, helping you with that business planning, consulting, coaching, helping you with the services like bookkeeping and payroll, in addition to 401k and other benefits. And then beyond that, we do a great job of trying to be on your side, not maximizing profits. We love technology. Even if you don't, we do it for you. So you don't have to be a super tech person, but we are on the leading edge of things, helps us drive down costs, do more for less. It's tons of great benefits for our clients. And then we really do believe in people before profit. You can check these out, learn more about us on our website. This is our team right now. I'm not going to hit into everything, so I want to answer some questions, of course, some disclosures about a lot of the things you looked at. So hit questions. If you're ever interested, you can always use this little link right here, pull it up on your phone, and you can schedule an appointment with one of our coaches, advisors, anytime. So first question in here, do you think housing will become an even worse contributor to inflation with tariffs and a likely reduction in the immigrant workforce? I think that housing will continue to be expensive and contribute to inflation. I don't know that it's going to make it a ton worse, but it's definitely not going to get better because you look at higher interest rates, the costs of goods, and immigration, a lot of the construction workers, like we're not investing in these things, and it's more expensive to borrow and to build, and people don't want to take out loans to put towards the builders to build houses. We need to increase our housing production. We need to build more houses and apartments and condos, whatever. We have a supply shortage, and that is hugely easy to see. We're way behind building the last 15 to 25 years in our housing supply, and all those things that I just said need to happen. We need to have some lower interest rates. We need to have the government have a serious plan about it. We need to maybe even have support for people as they're moving to different areas and changing. And it's not, none of these things are falling into place. So there's just not a lot of incentive to build it. It's not going to get better. I think the housing has increased so much, it would be difficult for it to keep going up just because I don't know, except for the, kind of more super wealthy, which are less than like 4% of the population, that a lot of America could continue to pay a bunch more than that, right? So that would stop it from going higher just because you can only sell something for what somebody's willing to pay, right? And so if people just can't pay more because they wouldn't be able to service the debt on that and they don't have the money, the price just can't go a lot higher. But if we don't build stuff, neither is it going to go down, right, to make things more affordable for people. And if interest rates don't go back down, we got a problem for a while. We're stuck unless something else comes out of the woodwork, like some productivity efficiency, or we can build houses for less, lower labor costs, or lumber, or however we do it, or the government steps in and says, hey, we want to help subsidize affordable housing. Maybe that's, bigger down payment credits, but there's no plan for any of this, and we're getting rid of our cheap labor, and so it's going to continue to be a problem. Is there anything that the middle class or lower Americans can do to protect themselves from potentially increasing inflation? The middle class and lower, it's tough. I would say you got to vote, and unfortunately, a lot of the promises that different politicians will make in terms of saying that they're going to lower prices, they're going to do this, they're going to do that, a lot of them are like campaign slogans. If you're looking at the current administration, a lot of what they're doing, even though they promised that, almost everything they're doing is inflationary. So it's not going to reduce prices, it's going to increase them. The question is how much, right? Is it going to be that big bonfire like I talked about, or are other things going to come together to keep it down? But it even would have been lower if we wouldn't have done these inflationary things. It's definitely going to cause inflation. And so I think for middle class and lower, the main thing you can do is vote for somebody that's really going to lower prices for you. And so that would have been like good housing. It would be supporting people that will bring the labor costs down. If we could get a balanced budget and stuff, but of course that's hard. If you're going to support some of these other problems, you got to spend some money. It's tough because if you're wealthier, then you invest in things that do better than inflation historically, but you got to have a bunch of extra money in savings or investments to do that. So unfortunately, this whole series of inflation for middle class and lower is only going to make wealth inequality worse, because the people that have the money that can invest in things that'll fight against inflation, businesses, certain types of equity, your stocks, sometimes commodities. When you can put a decent amount of money into these things, then they'll, on average, it'll jitter around like you saw those charts. But on average, those things will beat inflation. So if you've got money, your money's actually going to get bigger after you minus out inflation. Whereas if you're lower on the totem pole, you're going to be poor. Now, the only exception to that is if you get your wages to go up, right? So I guess that is one. If you can find a way through education or building out your network or moving your way up through work or whatever to get your wages to go up faster than inflation, then that is probably pound for pound, based on where you are, probably the best thing of beating inflation. But when you look at that track record in the United States, that wage growth versus inflation for middle class and below, that's not a great track record at all. And when you look at like the probability of like the American dream of like changing your socioeconomic class, it's less than half. You have less than half the chance that you did 20 to 50 years ago, right? And so even that social mobility is less than it was. And so it really doesn't look good in the short term for the middle and the lower class right now, even though you've got a very populist government right now. I think the reality of economics and everything is that unfortunately it's going to do the opposite to them of what they voted for. Okay. Again, I think really in terms of middle and lower class, you got to vote I'm not talking about Democrat or Republic, but more vote your wallet, but not in the short term, in terms of someone that's more progressive, that's saying, hey, we're going to use more resources to help the middle and the lower class take care of these problems that are long term in terms of job security, social mobility, housing, education, getting student loan higher education under control to where it's affordable versus what the economic benefit is later in life. And that's harder because sometimes that goes against what your friends or what's popular out there, or what most people in the church are saying. It's difficult. I know a lot of people aren't necessarily voting their economic interests, unfortunately. So go ahead and wrap it up, because again, I said I like to be respectful of your time. Please feel free to schedule. Thank you very much for spending time with us. Again, check us out for our next. I know these don't all apply to people. You can subscribe to come to all of our webinars in the future, and then only show up for the ones that you like, but then you'll get reminders. You'll be on it. If you miss it just because you're busy, you'll get the recording. Our next one is another university one. We're actually going to take some advanced strategies for full 3B and deferred comp, which is kind of like school systems, 401ks, and some of the cool things that you can do there to reduce costs, have better investment options, partner, etc. Then we're going to do financial planning. You've saved a lot. Are you ready to use it? So like income planning, and how do you actually like enjoy your retirement and not just be the richest person in the graveyard, and how to do that efficiently. So again, thanks so much for joining us. Stay warm, stay safe, and hopefully we will see you again sometime soon in the future. Talk to you then. Bye-bye.